Hey, good afternoon, everybody. I want to welcome you to today's Model ETF Portfolio webinar. Today's Wednesday, October 12th. You got John Hopkins here. Tom Bowley going to jump in just a quick minute. If you're new to Earnings Beats community, I want to welcome you. Also, of course, our wonderful subscribing members who have been just so many of you loyal for so many years. Thank you so much for believing us through thick and thin. Today's event, like all of our webinars, will be recorded. If for some reason you're unable to stick around, that's not a problem. We'll make sure you get a copy of the recording. Generally, they come out the evening of the event. Well, needless to say, first of all, we haven't had a webinar in a while, and we have a load of them coming up this week. You can just go to our calendar on the website and see everything that's going on. And it's going to be just a very active month of events. So much has happened, since our last webinar in terms of the market, seeing some fresh lows from a couple of years, for that matter. Question is, how much farther do we have to go? Are we getting ready to have a nice rally or maybe sink some more? Hard to tell. But I know Tom Bowley just got back from a great event in Seattle, the Stock Charts Conference. Tom, it sounded like everything went well.
Yeah, I had a really good time. It was a lot of fun. It had been 4 years since all of us got together at ChartCon. It was 2018. The last one that we had scheduled in 2020 was postponed because of the pandemic. So it was really nice to get out to Washington. Stock Charts is located in Redmond, Washington. So we got out there, and I was one of 17 technical analysts that spoke at ChartCon this year. And just about everybody was there. A little disappointed John Murphy wasn't part of this one. He's been a part of all of them that I've been to, and this was the 6th ChartCon, so it would have been nice to see John, or at least hear from him. But he didn't make it. But they did have a couple of new folks in that many of you probably are familiar with: Linda Raschke, Larry Williams, Ralph Acampora, just amazing analysts that I was able to meet. Linda was doing her presentation remote, but everyone else was there. Also got to meet Jay Woods, who many of you probably have seen on the New York Stock Exchange floor. He's on CNBC from time to time. He's a market maker. You can only imagine how that conversation went. Had a really good discussion with him, and he actually confirmed some of the things that I believed that market makers, try to do in terms of manipulating the retail trader. And so it was a great event. I mean, just had a wonderful time, and it's good to be back, though. I'm still trying to catch up, a little bit of jet lag, but
Yep.
Other than that, it is good to be home and good to be doing another one of these events. It's been a while.
Yeah, and you and I talked over the weekend. It sounded like, I guess I'd have to say that the consensus mood is pretty darn bearish. Just like everything we're seeing in the market, these days, nobody really has anything good to say about the market, Tom.
Yeah, it was interesting out there. I was in the minority for sure, being bullish heading into the fourth quarter and into next year. I will say Larry Williams was very, very bullish. Linda Raschke maybe a little bit, more bullish than most, but I don't know that I would throw her right into the extremely bullish camp. But Larry Williams and I both kind of had similar views on the market right now and where we might launch from or take off from. Of course, back in June, I thought that was the bottom, and we had that huge run. The S&P 500 went up 700 points in about, 2 months, maybe less, just under 2 months. And now here we are again. We come all the way back down. We gave away all those points and literally sitting just beneath the June low. And we got a big CPI report coming out in the morning. So a lot of folks are nervous. You could see that a little bit into the close. We closed right on the low. Last 5, or actually I think the last 6 days now, the S&P 500 is closed lower. and right back down to where we were at the end of September, and a little bit lower than where we were in June. So tomorrow morning is going to be interesting because, we've had the Fed meeting, we had the PPI come out this morning, we got the CPI tomorrow. And then after that, I think many eyes will turn to earnings, which start on Friday with JP Morgan and some of the other banks kicking things off. So never a dull moment on Wall Street. And I think things are going to, we're going to get a lot more information here over the next couple of weeks.
Yep. Of course, we've had some warnings lately. AMD, after the bell today, AMAT came out with their warning. Stock's down a few percent, after hours. It's been bludgeoned by 50%, for the year. It's going to be interesting as more and more companies warn, it might get to the point where, tell us something we don't know. So it's going to really be interesting to see how, traders react to these kind of things. But anyways, I know you want to jump in and get things started here, so I'm going to go ahead and turn it over to you.
All right, sounds good. Welcome, everybody. Appreciate you coming in. Hopefully some of you attended ChartCon. It was really a great event. It's always, for me, it's nice getting so many technicians that I have so much respect for in one place and really listening to what they have to say about the market. It makes me at least think about my bullish stance. I don't typically waver. I do tend to have a lot of conviction based on the things that I follow because I've researched. I mean, I'm not just watching, the S&P 500. I mean, obviously, if you're doing that, we're setting a new low. That's going to make you pretty bearish. But there's a lot of other things that go into the market, and I'll go over some of those this evening and try to explain a little bit about my bullish stance. And also, this is about the model ETF portfolio. So one of the things we do here at Earnings Beats is we do portfolios. We have 3 stock portfolios, and we have this one ETF portfolio, the model ETF portfolio. And, we're trying essentially just to beat the S&P 500. We don't try to time the market in the sense that we don't keep cash in any of these portfolios. What we're trying to do is simply use all the information that the market gives us, and we try to put together these portfolios that over time will outperform the S&P 500. Some quarters, obviously, we've done better than others, but over time, I think overall we've done really well, especially with the model and aggressive portfolios in our among the stock portfolios. The model ETF portfolio is a little bit different because we don't pick the stocks. We try to go into certain themes that we believe in, but the stocks themselves are in these portfolio or in these ETFs. And so we do take a look at the ETFs, and I'll show you a little bit about how we do that in just a little bit. But it's really about trying to study the themes of the market and try to get ourselves in a position where we're able to be somewhat successful. We've actually done a pretty good job with our model ETF portfolio in 2022, because back earlier in the year when I thought we were heading into a cyclical bear market, we the model ETF portfolio goes from it goes 90 days. So we have these drafts on January 19th, April 19th, July 19th, and October 19th. Of course, October 19th is coming up next week. Today is October 12th, so we're just doing a little sneak preview, kind of give you a taste of what we try to do when we put these portfolios together. But since I looked at it a little bit earlier, let me see if I can find the number here. Since January 19th, now remember, as of October 19th of last year, I was still bullish, and I hadn't really turned bearish until the end of December or early January. And then we started to see the breakdowns on top of some of the warning signs, and all of that led to where we are today. So starting back on January 19th, I started to change our philosophy quite a bit. I grew much, much more cautious and tried to structure the portfolios. And again, we're fully invested, so we don't try to time it. If our members want to be 50%, then just put 50% into the portfolios or into the stocks within these portfolios or ETFs. You can make that call. We're not registered investment advisors, so I try not to come across as suggesting or telling folks what they should be doing with their money. I have no idea what everyone's risk tolerance levels are, what your financial objectives and goals are. I don't know how old you are and whether capital preservation is most important to you, or whether you're younger and maybe you're really aggressive. You might be older and you might already have, all of your nest egg put away, and you might have an aggressive portfolio that you're dealing with. But I have no idea of any of this for everyone. So it would be really irresponsible for us to simply tell everyone to just do this. One size fits all. That would not be responsible at all. So what we try to do is really use these portfolios as an educational arm of earnings beats and teach folks how we put them together. And then you can decide how much exposure you want based on our guidance, based on our research, our education, all of these portfolios. That's really what this is all about. So as we go through this tonight, I'm going to tell you what I think about the market. I'm going to show you some different areas of the market that are doing well, some areas not doing well, and how all of this might factor into some of the decisions we make for next Wednesday in putting together this portfolio. So I'm going to go ahead and share. You haven't seen anything on your screen yet, but let me share the screen and at least show you the S&P 500. And while you're looking at this, all right, you should have the S&P 500 up. This is just a one-year chart. But what I was doing, January 19th was when we started to fall apart. Now, back here, we were already seeing some warning signs. We had Market Vision 2022, which has been a spectacular event for us for the last 3 years. That was on January 8th, Saturday, January 8th. And it was right here that I talked about the direction of the S&P 500 this year. And I said, at a minimum, I expected the S&P 500 was going to go back down to about 4,300. If we stretch this out a little bit, I think you'll probably, let's just do 2 years. You get a little bit better indication of what I was looking for. So right here, I said, I thought we would probably go down to 4,300. That was the low here at the end of September, beginning of October of 2021. So I thought, okay, we're going to go back down there, probably test that. Just based on the way the money was rotating, Wall Street was getting very defensive. We had a lot of sentiment issues. So this is the short-term or initial support that I was looking at going into this year. And then what happened from there would dictate whether or not this was really going to evolve into a cyclical bear market. Well, first move down, we went below 4,300 intraday, but we held it and we bounced back, looked like we were going to try to make a move, and then went back down to a lower low. And it was really on this move to the downside that I grew convinced that we were going to go back down to what I thought would be the worst case scenario, which was 3,500 to 3,800. That was what I announced back on January 8th. And you can see where we are right now. We're at 3,577. We are in that 3,500 to 3,800 range. And it was one of the reasons why I thought the June low was it, because this was a range I'd already determined, I'd looked for, thought we were going to go down there probably within the first 6 months of 2022. We got there. Sentiment was reset. Rotation started to change. I'll show you that in a little bit. And so I thought this was the start of the resumption of the secular bull market. And we went back down here, and those of you that are members will recall, right here as we turned back up and went back through that 20-day, I mean, I really started to get very, very bullish. And then the Jackson Hole speech right here on August 26th happened. And that's where Fed Chief Powell said, there's more pain ahead, tried to start editorializing things and become a stock market prognosticator instead of the Fed chief that he is. And that changed not just the short term with that move down, but I think it changed the Fed's credibility with Wall Street. And so this move to the downside, I think, has been more about the credibility of the Fed than it's been about anything else. That, again, just my opinion. The whole downtrend started on that Jackson Hole speech. I think we were ready to make the move to the upside. I also think that the Fed is making a mistake. I think they're raising too much, too fast. I don't think they're sitting back and letting these things, run through the system. Yes, there are still signs of inflation out there, but there are also signs of deflation starting to pop up. Inventories are starting to rise. Demand is slowing, supply chain starting to catch up. All of that could lead to a deflationary issue in another couple months or maybe in the beginning of 2023. So I think once the Fed realizes what the heck is going on here, I believe we're going to see a big pivot. And they're going to go from aggressively hiking rates to potentially aggressively cutting them, or at least stopping the insanity of what they're doing. And again, these are just my words. You don't have to agree with me. I think they're insane right now. But we'll see. We'll see how it all plays out. I do think the market's going to turn and go back to the upside. I think we're going to, it was interesting when I was out at ChartCon, I sat down, I was talking to Mish Schneider, who's one of the contributors over at Stock Charts. I had never met Mish before, but we got to talking and we became pretty good friends and talked a lot about the market. And I think it was on Saturday morning, it was the second day of ChartCon. Saturday morning, I was sitting in Stock Charts. They have this huge kitchen where a lot of us were gathering, a long, very long table and some booths and a huge couch and a couple large TVs, along with, everything else you'd expect in a kitchen. Anyway, she comes down, she sits down next to me and she's looking at her stuff and she's like, wow, she's like, I just don't see the S&P 500 hitting a new high for many, many years. And she said, what do you think? Am I crazy? And I just looked at her and I said, I think we'll be there in January or February of next year. And she said, what? I mean, that's really the diversity of opinion, even among technicians. And I respect Mish's work and I respect everybody at ChartCon. And if we took a poll, there probably would be certainly more than half of the technicians probably believe we're going significantly lower. So I'm not in the majority of the technicians. I did have some on my side. Larry Williams, again, he was very bullish. Greg Schnell, good friend of mine, we were talking about it. And he believes we're going to have a rally. I don't know that he's of the long-term rally mindset, but he thinks that we're ready for a rally now. So there were, again, varying opinions, but my point is nobody, we don't have to agree because nobody really knows what's going to happen. All we can do is just go back and maybe gather some of the evidence we have from prior bear markets or from prior studies, or maybe you look at the news. I don't look at the news. I don't listen to the news. The chart tells me everything I need to know. I don't need to know what anyone's spin on the news is. I can look at the chart. I already know we have an inflation problem. Nobody has to tell me how bad it is or how bad it's going to get. The way Wall Street trades is going to tell me to a certain extent how bad Wall Street thinks it's going to get. And when I talk about Wall Street, sometimes I'll get questions from members. What do you mean by Wall Street? I'm talking about the big Wall Street firms. I'm talking about Goldman Sachs. These are the companies that have hired some of the brightest MBAs out there in terms of, their financial acumen. They're brilliant people. And Goldman Sachs and all the other big financial firms, they're market makers. They have market making units. They have institutions and pension funds and so forth as clients. And they're investing their money. They're investing their own money. And so when you see the rotation that's taking place in the market underneath the surface of the S&P 500, that can give you a lot of really good clues. Anyhow, my point, I went way around in a circle here. But my point was, and the reason I brought this up, I wanted to tell you how the model ETF portfolio had been performing since January 19th, because this is when we had broken down. This is when I started getting new information, and we started adjusting the way we invested in the S&P or in the model ETF portfolio. Since January 19th, since we started this portfolio right here, that's when we started getting a little bit more conservative. The last quarter, actually, we were very aggressive starting on August 19th, right in here, which you would think, my gosh, look at this. That was a bad choice. or excuse me, it was July 19th. So we had to move up, but now we're way down from where we were. Still, probably not a very good choice to be in a lot of growth stocks, but you'll be surprised. All of our portfolios, all of our stock portfolios and our model ETF portfolio holding up very well versus the S&P 500 this quarter. The model ETF portfolio is down about maybe 1%, maybe just under 1%. Yeah, 0.82% below the S&P 500. So we're underperforming a little bit this quarter. Our stock portfolios are all outperforming the S&P 500, and those portfolios were on August 19th, and they're all growth oriented. I switched to growth because I thought the bottom was in. We went back down. You'd think that these portfolios are getting killed, but I think that's another bullish sign. We've got growth oriented portfolios that are beating the S&P 500 during this decline. That shouldn't be happening. What it's telling us and underscoring is that Wall Street, these big Wall Street firms, are rotating. Yes, the S&P 500 is getting hit to the downside, but the money is rotating into more aggressive areas. Why in the heck would you do that if we're going to see another 3 months, 6 months, or a year of downside action? I'll show you the rotation I'm talking about in just a little bit. So anyway, since January 19th, the S&P 500 is down 21.08% through today's close. I actually updated this at 4 o'clock so that I have this for tonight's presentation. S&P down 21.08%. The model ETF portfolio, fully invested, is down 15.08%. We've actually outperformed by 6 percentage points since January. And the primary reason is that we got very defensive in our portfolios during this period while the market was going down. So we wanted to make sure that we were intentional in moving into more defensive areas. We wanted to be more cautious in 2022 while this cyclical bear market played out. And then, like I said, once we turned in June, when we had our last model ETF portfolio draft in July, we got much more aggressive and we were doing better. We were actually outperforming the S&P during this stint, but then we've given it back and we're a little bit below right now with a week to go. So we'd have to have a pretty strong week probably to overtake the S&P 500, but still we're fairly close. Year to date in 2022, and keep in mind, we got hit pretty good here because growth stocks were getting hit. And we were heavily in growth stocks those first 3 weeks of January until the draft hit on the 19th. But since the beginning of the year, the S&P 500 is down 24.95%, or basically 25%. And the model ETF is down 20.19%. So almost 5 percentage points better. Anyway, that's history. Of course, nobody cares what you did last quarter or last year. It's all about what you do next quarter and next year. And so what I want to do next is just talk about some of the themes, some of the things that we need to be aware of. When I am putting a portfolio together, whether it's ETFs, whether it's individual stocks, whatever it is, I like to be aware of the themes. I like to be aware of the overall market. Do I believe we're going to go higher? Do I think we're going to go lower? If the market's going to be strong, it's usually led, history tells us that it's usually led by the aggressive groups, technology, consumer discretionary, communication services, industrials, financials, some healthcare. Those are the groups that tend to lead. In an uptrend, the groups that tend to fall back, or on a relative basis fall back, are your defensive groups: utilities, consumer staples, real estate, and some areas of healthcare. The two wild cards when you're putting together a portfolio, you just have to decide individually whether you're a fan or not: materials and energy. They can go up in a bull market, they can go up in a bear market. They can go down in a bull market, they can go down in a bear market. I mean, they just kind of, I don't know, they move to the beat of a different drummer when it comes to their trends. There's so many geopolitical concerns, so many other things involving the dollar and the like that can have a very significant impact on energy and materials. So when I'm looking at these themes, for the most part, I'm looking at the 5 aggressive groups, the 4 defensive groups. And if I have a particular like or dislike about materials and energy, to me, that's a little bit of a separate thing that I'm looking at. I mean, we saw, for instance, let me just give you a quick, for instance, on energy. When the war broke out between Russia and Ukraine, we saw crude oil prices take off. Had absolutely nothing to do with anything in the US. It was completely outside of our control. And literally, as soon as that war broke out and supply was cut off, or at least limited, then we saw prices absolutely explode to the upside. Same thing happened during the Gulf War back in 91. So it's just hard to plan for the next 3 months on what energy is going to do, and maybe to a little bit lesser extent what materials are going to do, because there are just so many other things outside our control and outside our country that impact many of those stocks and commodity prices. So as I look at the S&P 500 here, so this is a 2-year chart. I mean, I don't need to tell you we're in a downtrend. We're in a downtrend. I think it was, I don't remember if it was Ralph Acampora or Larry Williams, but one of them was just, I think it was Ralph. Basically, he was just stripping down all of the chatter and noise and everything else and just said, listen, are we putting in new highs or higher highs and higher lows? Or are we putting in lower highs and lower lows? Well, I think it's pretty clear right now. We just put in a lower low. I think we've been putting in lower highs. We've got a downtrend on our hands. That shouldn't be a shocker to anyone. And at the very base, forget about anything else that's going on in the market. We're in a downtrend. We're in a bear market. Call it cyclical if you want, call it secular if you want. The difference is the time frame, the duration, and how bad it gets. Well, we've only been in this for 9 months. We don't know if this is secular. I don't believe it is, and I'm going to tell you why in a couple minutes, but I believe it's cyclical. I think that, and it was the same thing I said back at the beginning of the year. I suggested it would be cyclical, and I still think it's cyclical. Anyway, but there's no denying we're in a downtrend. And if you're a pure technical analyst, before you look at anything else, you should recognize that we are downtrending. And until we put in higher highs and higher lows, I personally, I was looking at this as a higher high, higher low, higher high, higher low, and we were moving up, but we never took out this trend line. So that move that went up to over 4,300, yeah, in the short term, it was an uptrend, but still in the, when we look back to the end of the year, I think the bigger argument is that we're still in a downtrend. But I don't think we're going to stay there. And I'll get to some of that later. Let's start off with sentiment. This was a chart I showed back at Market Vision 2022. This was on Saturday, January 8th. And this arrow right here was pointing, we were just breaking out to the upside on this 253-day equity-only put-call ratio. This is just a long-term look at sentiment. And you can see that if you're not familiar with the equity-only put-call ratio, it's equity puts divided by equity calls, put-call ratio. Puts are the numerator and calls are the denominator. And so as you get a high reading, it means folks are getting bearish, more puts relative to calls. When we're down here at really low readings, it means that there's hardly any puts relative to calls. And so what happens in the stock market is when you're looking at a 253-day moving average, think of this as the cruise liner of sentiment. A lot of times I'll talk about the 5-day moving average as kind of a really short-term indicator of sentiment and how the market can bounce when we get 5-day moving averages of the equity-only put-call ratio that get to certain levels. That's the speedboat sentiment indicator. This one is the cruise liner. Speedboat, go really fast and turn on a dime and go back the other direction, turn on a dime, go back. The cruise liner just kind of gets going in one direction. It takes a while before it actually turns around. Very, very difficult to steer it. You can't turn it like a, like a power boat. Back at the beginning of the year, we were looking at sentiment readings that were literally off the charts to the downside. Look at this. Look at where we were. Since we've been seeing, since these equity only put call ratios have been coming out since 2004, the lowest we ever saw on the 253-day moving average was 0.575 until this huge move post-pandemic in the S&P to the upside. Everybody got bullish. Everybody was buying calls. Nobody was buying puts. The stock market was an ATM machine. You just buy whatever and it goes up. Somebody on Wall Street Bets says buy GameStop. You just buy it and it goes up. You make money. Hand over fist. Piece of cake. That's what sentiment got to. It got to the point where nobody knew what a pullback felt like. Many of the people that got into the stock market in 2020 and 2021 had never seen a correction, had never seen a bear market, didn't know how bad things could get, how bad things could feel. We needed this sentiment number to reset. And I could show you a number of articles I wrote at the end of the year, and we could point back to the recording at Market Vision 2022. I have said all along, this was the biggest event of 2022. We needed to reset sentiment. The stock market could not go higher. It could not launch with sentiment readings down here. It couldn't. Everybody was in. People were finding new money to put in the market because it was an ATM machine. How many of you feel it's an ATM machine right now? Probably not too many. Maybe if you've been shorting, but you know what? That's just flipping the sentiment. If you're shorting or if you're playing puts, all you're doing is we're just turning the page from where we were at the end of 2022 or 2021 to where we are now, which is a much different place. Now, everybody I talk to is bearish. I do a YouTube video and I'm bullish and I get 150 comments on how nuts I am, which only underscores what I'm saying. Perfect. That's perfect as far as I'm concerned. This is the whole idea of resetting sentiment. Look at the history. We go down in sentiment, the market goes up. The sentiment then turns to the upside. Now we're getting more bearish. 2006 to 2009, we were getting more and more bearish. Well, that's when we were in that secular bear market. Big drop. Once we reset sentiment to a ridiculous level of bearishness and we rolled over and started to turn down, the stock market had one of its best 2-year runs in history. Then what happened? Well, we grew too complacent, too bullish. We turned back up again in 2011, 2012. Look what happened in the market for a year and a half. We went nowhere. Then, after the sentiment was back up, bearish again, that's when we were able to launch. As we launched higher in the S&P, the sentiment started to come back down. What happened? Everybody got back into the bullish camp. Now everybody's buying calls again. What happens? We turn. We go 2 years. Remember 2014, 2015, 2016, sideways. Then too much bearishness. I mean, I remember 2016, a lot of folks going into the election or, after the election figured the market was doomed. And everybody was bearish. And so we reset, came back down. We had one of the biggest bull markets we had seen. And again, over a course of a couple of years here, up 47%. Then between the trade war, the pandemic, I mean, this was just a crazy period. This is the cruise liner trying to be a speedboat. So it really never gave us any clear signals. And throughout this whole period, basically, we went nowhere. And then after the pandemic, you can see this drop, this historic drop to a historically low level in the equity only put call ratio. 253 days, the average was down under 0.475. I could show you periods where we hardly ever had individual daily readings below 0.475. And here's our average for an entire year. That's where 253 days comes from, by the way. 253 days, and that's how many trading days are in a calendar year. So we needed to reset sentiment. That was the biggest problem in my mind. You could blame it on inflation. You can blame it on interest rates. You can do it on what the market made an unprecedented move in 22 months. The biggest move that had ever made in 22 months, going all the way back to 1950. Everybody was buying. We were too optimistic. We had gone up too much. We were going to go lower. In my opinion, the risk, and that's why I do technical analysis, is to evaluate the risk. The risk of being long at the beginning of this year, in my opinion, was off the charts. The worst risk reward that I had seen since earnings beats has been in business. And now we can see what's happened. That cruise liner is now heading straight for, bear market Armageddon. I mean, everybody right now thinks of, oh my gosh, we're going down to 3,300 to 3,000. We're going to go down and hit that low down in the pandemic, 2191. So I've seen people talking about 1,500 on the S&P 500. If we go down to 1,500, it'll be the worst time in the history of the stock market, except for the late 1920s and early 1930s, the crash. I mean, if you think that's where we're going, by all means, short. You make a lot of money. I wish you luck. I don't think it's happening, but sounds interesting. Anyway, this has now reset. Now we're back to at least an area where we're sane again. All those folks, a lot of folks that thought the market was an ATM machine, either have run out of money in their trading account, or they've now taken new money and now they're experts on the bearish side. They're going to just keep buying puts. And you know what? That's going to hurt them, just like buying all the calls. So this is a major theme, though. If I was putting together a portfolio, things are so much different now than they were 9 or 10 months ago. Just from sentiment, we could see a reversal on this at any time and start to move back down again. My guess is, now that we're over 0.60, somewhere in this 0.60, 0.65 area, I believe we're going to turn back down. I don't think we're going all the way. Some say, well, why wouldn't we go all the way back up here? Well, we were already somewhat bearish before we made this last big push in the put call ratio. Here, we're starting off from an incredibly low level. I don't think we're going to go from this level to this level during this bear market. I just don't. I think moving back into this range, I mean, even back up past 0.575, I think is really bullish for the market. So I'm already thinking much, much more bullishly now because of sentiment than where we were 9 months ago. Of course, everybody's interested in 10-year Treasury yield interest rates. As the rates keep going up, this is the 10-year Treasury yield. This is the NASDAQ. I mean, do you see a pattern here? Big move up in yields, big move down in the NASDAQ. Yields pull back, NASDAQ goes up. Yields rise, NASDAQ back down again, and back down below the prior low. So if my thinking is correct, that the Fed's going to pivot and rates are going to come back down, if I'm right, that would be the catalyst for the NASDAQ to take off again to the upside. Now, some of you I know are like, well, the Fed, you don't want to fight the Fed. And for the most part, I agree with that. But I'll tell you what, the stock market's not going to make an announcement telling you when Wall Street firms are buying back in hand over fist. I think it's already happening. They're not going to be surprised when rates start to fall. We might, but they're not. So just remember this chart. Yields, if yields break out above 4%, I mean, we'll still have a negative divergence in play on the daily chart. We got a negative divergence on the weekly chart already, which is pretty significant in my opinion. But if we break out, that obviously would be an argument for stocks to fall further. If we don't break out above 4%, begin to roll over, especially, if we clear below 360, that to me would be a pretty significant sign that perhaps the worst is behind us. All right, John mentioned AMD. I wanted to bring up AMD and I wanted to just show you, first of all, I was not at all surprised by AMD warning. I'm not at all surprised Applied Materials warned after the bell today. I wouldn't be surprised if many of these semiconductors warn. Look at the semiconductor chart right here. This is semiconductors going down, setting new lows. Look at semiconductors relative to the S&P 500. We're almost at a 52-week low in terms of relative strength, or in this case, relative weakness. Wall Street's been moving out of semiconductors for the last 10 months. And if you look at here, AMD, look at AMD relative semiconductors. Now, here was the warning right here. Look at where we were prior to the warning. AMD was at a 52-week relative low to semiconductors, which were at a 52-week low relative to the S&P 500. You've got one of the worst stocks in one of the worst groups with AMD. Should we be surprised that they warned? I'm not. Sometimes you look at a stock like AMD and you say, wow, it used to be a $160 stock. You know, when it gets to 100, you want to go all in. Well, guess what? It gets a little bit cheaper. It goes down to 85. And then you're thinking, wow, 85, what a great deal. It starts to rally. Then it goes down to 72. Oh, even better deal. Now it's rallying. Well, guess where we are now? 58. I can't tell you if we're going to go back to 70, if we're going to go to 45. But what I can tell you is that Wall Street doesn't like AMD right now. We always talk about leading stocks in leading industry groups. That's what you want. AMD is the exact opposite, the polar opposite. It's a very weak stock in a very weak group. You can lose a lot of money in these relative downtrends. Stay away from AMD. AMD will tell us when it's time. This chart will tell us. Don't worry about missing the very bottom. Now, semiconductors are a really big part of a secular bull market. And I'm not going to lie, this is one of the areas of the market that keeps me up. When I talk about putting in bottoms, you know, one side of me tells me, don't call a bottom with the semiconductors going down. But as I say many times, calling the direction of the market's a puzzle. You know, if you want to always be bullish, you can always find something that's bullish. If you always want to be bearish, you can always find something that's bearish. I try objectively to look at as many areas of the market as I can, put as many parts of the puzzle together as I can, and figure out what it looks like. If I wait for everything to line up bullishly or everything to line up bearishly, I'll be sitting on my hands forever. I'll never make a call. And that's why I tend to keep my charts pretty simple. I don't have, 20 different overlays and all these different indicators on my charts, because if I had all those, I would never be able to make a decision. Something would be pointing bullishly and something would be pointing bearishly at all times. Keep it simple. If a company is trading weak relative to its group, and its group is trading weak relative to the benchmark S&P 500, stay away. Look for leaders, not laggards. AMD will probably at some point be a great stock to own. And you know what? It might be when it's 80 or 90. I might not even hit the first 50% move. And I don't care. I don't want to get caught in this. That's painful. That's how you ruin portfolios. Follow what Wall Street's doing. They'll give you a good idea. All right. Why am I bullish? Why do I think this is a cyclical bear market? Well, this is a 100-year chart of the S&P 500. Many of you, if you're Earnings Beats members, have seen this before. But I'm a fan of these grand super cycles. Interest rates have gone back up. 10-year Treasury yields near 4%. It's gone up a lot. I'll acknowledge all of that. But I also realize that 4% historically is still incredibly low. When interest rates are low, and I can only say this from my background being a practicing CPA for many years, I did valuations. Interest rates being low or falling will significantly increase valuations of stocks. Significantly. One of the things that's really hurt the growth-oriented NASDAQ is the rapid increase in interest rates. If you believe that interest rates are just going to keep going up, especially at the rate they're going up, get the heck out of the stock market. Because if it keeps going up this rate, stocks are going lower. If that's what you think, then I would be out of the market. I mean, one of my themes or my thesis about this being a cyclical bear market is that this rise in interest rates is going to be temporary. If you look back to the 1960s, right in here, this second half of this secular bull market occurred with rates going up. We had very cheap money in the 1950s. We went into the 1960s. I think the interest rate was right around 1%, maybe 1.5%. I don't remember exactly. During this period, while we kept going up, the Fed was raising. That's what led to some of these cyclical bear markets. But we stayed in a secular bull, long-term bull, short-term bear. We go into the 1980s and 90s, long-term bull, short-term bear. 1987, that was really a big hit, very similar to the pandemic. 1 month, 35% gone. And a year, 2 years, 3 years, 10 years later, it was a blip on the radar. This was painful in March 2020. 2 years later, it was a blip. And you know what? What we're in right now, it's painful. But I think a year, 2 years, 3 years, 10 years from now, it's going to be a blip because we're still in a low interest rate environment. Eventually, and I think probably by the end of this decade, maybe into the early 2030s, I think we're going to see something that's going to be really painful again. Probably, I think rates, while they're going up right now, I think rates probably drop again. Maybe they work their way up higher later this decade. And at some point, we will reach a peak in the S&P 500 that I believe will be much longer term before we see another high. That's what you typically see during these long-term secular bear markets. This is what I'm referring to when I say secular bear market. Late 1960s until the early 1980s. It was sideways. Two brutal moves to the downside, especially 73 through 75. 73, 74, actually bottomed in 74. That was brutal. 2000 to 2002, brutal. 2007 to 2009, brutal. Extended bear markets. These all went down more than 50%, lasted a couple years. Cyclical bear markets are like at least on this long-term chart, look more like a speedboat. You know, blip and then back up again, blip, back up again. This was the 2018 cyclical bear market. Remember the trade war in the fourth quarter, 2018? S&P went down 20% in 3 months, right back up again. The pandemic, 35% in 1 month, right back up again. 1987, 35%, right back up again. 1991 or 90, Persian Gulf War, crude oil prices took off, inflation spike, It looked horrible, took off again. All these, I think we had 3 or 4 recessions back in this period in the 50s and 60s. We took off again. I think we're going to take off. We'll see. Another theme that I'll be looking at, like this is the last 3 months. This is our relative strength in industry groups. There are 104 industry groups here, and I've got them ranked in order relative to the S&P 500 for the last 3 months. Now, I know the market's been bad over the last 3 months, especially over the last couple months since we topped in mid-August, but I want you to look to see what's been leading this. And I tend to ignore energy and materials because, again, to me, they're a wild card. What I'm looking to see, are there aggressive groups leading or are there defensive groups leading over the last 3 months? As we've been going through this period of rotation, up, down, all of this. Well, here's a technology industry group. If we ignore energy and materials, that's XLE and XLB, industrial, consumer discretionary, communication services, consumer discretionary, there's real estate, that's defensive, consumer discretionary, industrials, financial, discretionary, industrials, financial, technology, consumer discretionary, and then we finally hit a consumer staples group. So there's one real estate, there's one consumer staples, discretionary, industrials, financial, communication services. Then we finally get to another consumer staples. I mean, am I making my point here? Last 3 months, what are all these aggressive groups doing, leading the S&P 500 if we're going to go lower? Why is Wall Street repositioning into aggressive areas if we're about to, if the proverbial what's about to hit the fan? Why wouldn't they be repositioning into defensive groups? I mean, if we flip this over, there's communication services, forget about materials. There's real estate, defensive. We got a discretionary, communication services, real estate. Here's a real estate. We got utilities, staples. We're seeing many, many more defensive groups. Back in December of last year, I'm going to show you the S&P 500 here. Back in December of last year, you see this final move to the upside. Where did I have that other chart? Shoot. I had it set up. No, I don't want to have to recreate it. Well, I'll tell you what, I know where I can get it, or get one that at least looks something like it. We'll go into Market Vision. I don't know if I had all the growth. I'm looking for basically my sustainability ratios. I had this set up. Well, this isn't exactly what but this will suffice. This is just showing the aggressive groups relative to the S&P 500. Many of my sustainability ratios were very similar. But anyway, on the last move in the S&P 500 back in December and early January, when we set that last high, look at technology relative to the S&P going down. Look at discretionary relative to the S&P going down. Communication services relative to the S&P going down. Financials, kind of sideways during that period, mostly down, but then we came up right here at the very end. Industrials, mostly down. Still not going to show us the growth stocks. Let me show you this one. This is the growth the small cap growth versus small cap value. So this topped back in 2020, but you can kind of see what was happening in that last move when the S&P was going up. Look at how the money was rotating out of growth and into value. This is mid-cap growth versus mid-cap value. Look at December. Look at that. It's falling apart. Look at large cap growth versus large cap value. Falling apart. Look at the NASDAQ versus the S&P 500. Falling apart. All of these are all, this is growth versus value, or aggressive versus defensive. When we're going up in the S&P 500, these should be going up, and they're not. That was a major warning sign. Now, we went down and we hit a low in May on the S&P 500. Let me show you this chart. Oh, not that one. You see this low in May? Then see how we went lower in June, and now we're even lower still. But if I look back at these, where did I just have it? Right here. But look, since May, look at the growth versus values among small caps. It's going up while the market's going down. Mid-cap growth versus value going up while the market's going down. Large cap growth versus value is coming down the last couple months, but it still has not gone down below that May low. NASDAQ versus the S&P still slightly above that May, June low. And all I'm asking, the only question I'm asking here is why? Why would money rotate into aggressive areas right before a big meltdown down in the market? It wouldn't. If you believe we got inflation problems and rates are going to keep going up, that's what most people are pointing to, or a recession. I mean, another thing I could add in here, let's get rid of this CCPI. Let's look at the XLY, XLP. Look at the XLY, XLP back at the end of the year. Look at December. It actually started in November. So while the S&P made that last surge right here, the S&P was setting a high. The final high was right here. Look at the money rotating out of discretionary versus staples. Now we're making a new low, and look at the ratio. We bottomed in June. Look at where we are. None of this makes any sense to me that the market's heading lower. So, I mean, could we go lower? Yeah, we're in a downtrend. We've just set new lows. I can tell you I am long. I am in the QQQ right now because of my belief that eventually rates are coming back down and the QQQ is going to take off. Maybe I'm wrong. And if I am, I'm going to take a loss. But I'm not just saying something. I mean, I've got my money invested in the QQQ right now. And if I really get aggressive, if I really believe we're heading higher, I will probably swap out some of the QQQ for the QLD, which is the 2 times leveraged ETF that tracks the NASDAQ 100. So I'd just be doubling for however amount of money I switch over, I'll be doubling my risk. That's how bullish I am right now, but I'm not going to do it while the market's going down. I don't believe in buying and holding leveraged ETFs. They go down a lot faster, number one. And number two, if we get into a period of volatility, they lose value. They'll erode over time. So I'm just not interested in doing that. So I'll pick my spots. And if my spots don't work out, then I'll cut my losses on the leveraged ETF and I'll go back to the QQQ. That's my strategy right now. So anyway, the last thing I wanted to do here, we've been at this now for almost an hour. I'm going to stop sharing my screen for just a second because I have a I need to download our ETF analyzer. I just want to show you all, if you're not familiar with it, it's a really cool spreadsheet that we update once a quarter. So I'll have it updated for next week when we do the draft, but it's really phenomenal. Let me, okay, there we go. Almost ready. All right. So now you should see this Excel spreadsheet. And in essence, what I have here is I go through, I run a scan to try to find the best ETFs in terms of scooter scores. And I also like to make sure that they have a certain amount of liquidity. And then what I do is I list them here. So this was done when we did our last draft back on July 19th. And so I listed all of these different ETFs that were showing relative strength. So I went from 1 down to 34. So I did 34 of these different ETFs, and I'll show you what all these columns mean in just a minute. And then in addition to that, I added the 11 sector ETFs. So all the major sectors. I just wanted to have that as an option. And in fact, when we did the draft the last time, I wanted to actually get into some of the various sector ETFs to maybe mitigate some of the risk, because we were in a bear market. And even though I thought we were bottoming, I still wanted to be a little cautious with this model ETF portfolio. And I'm going to go into all that in just a minute. But this is all of the ETFs that I found were strong based on the scan I ran. And then I added the sector ETFs. Now, if you come across the top 10 is basically telling you, if you take the top 10 stocks in this ETF, the top 10 stocks add up to be 13.26% of that ETF. So just by looking at this column, you can see if any of these ETFs are heavily concentrated in one, in just in a handful or 10 stocks. For instance, this Fidelity Consumer Staples ETF, 61.9% of that ETF is in just 10 stocks. So you really need to like those 10 stocks if you like this ETF. The thing I always talk about with ETFs, or if you're going to have an ETF portfolio, is know what you own. If you're standing around the water cooler and somebody says, oh my gosh, this Fidelity Consumer Staples ETF, the FSTA, this is a great ETF. Well, first of all, you have to know it's defensive. So if you're really bullish the market, maybe that's not what you want to be in. You also need to realize that it's heavily concentrated in 10 stocks. What are those 10 stocks? Do you like those 10 stocks? I might look at them and I might not like them at all. I might look at their relative strength and find out that 6 of them are laggards among their industry peers. So I wouldn't want it. So we put this spreadsheet together to give you more information on some top ETFs. Now, coming across here, the other thing we do is we identify how much of that ETF is invested in each of the 11 sectors. And then I have this audit over here to make sure that they all total up to be 100%. So all of that is done. And the reason why, when you go in and you say, okay, I want to put in, look at this year results right here. You'll see 0% because we haven't allocated any of our money yet. If I were to say, okay, give me 100%, I'm going to put all 100% in this one ETF. See what just happened up here? It just took this 16.96% and put it here. This is now how much you have invested in each of the various sectors. And coming across here is how much the S&P 500 has invested in each of these groups. So you can see immediately you're underweighted in technology. You only have half of consumer discretionary. But look where you're a little bit heavier on. You're heavier here in healthcare and in consumer staples, utilities, So this is going to be a little bit more of a defensive ETF, which maybe you like, maybe you don't. And again, what stocks? Well, we have this tab, top 10 holdings. I can go look at ACWV. There it is. It's ETF number 1, ACWV. Here's that 13.26%. And here are the 10 stocks that make it up. Now, here are 2 with the asterisk. You go up and you see these are OTC market stocks. So these are over-the-counter stocks. Some of these have prices on stock charts. Some of them don't. So if this was 12% of my ETF and I can't even track it at stock charts, I wouldn't even consider it. I mean, I want liquid stocks. I want stocks that I can find at stock charts and be able to follow. Now, as you go across here, you'll see here are the top 10 holdings in order. Number 1 holding down to number 10. You can, as you go across, you'll see if any are really heavy just by looking at this number. 50% of FHLC is in these 10 stocks. And 2 actually looks like healthcare. This is, looks like all of these are healthcare, and it's heavily concentrated. So if you wanted healthcare ETF, this might be a good one, especially if you're a fan of UNH, J&J, and Pfizer, PFE, because that's close to a quarter of the entire ETF just in those 3 stocks. Here, this FSTA, 61.9%. That was the consumer staples. Procter & Gamble's 13% of the entire ETF. So you might get in and think, I'm really diversifying. Well, except that however much you put into this ETF, 13% of it is in just Procter & Gamble. You're not as diversified as you think. So anyway, I think this is a pretty cool feature that we've put together. This is our ETF analyzer, and this is how you can go through and allocate. So next week, I will be providing another one of these spreadsheets where we list, maybe there's 30 of them, maybe there's 50 of them, maybe there's 70 of them, I don't know, where I will list the ticker, the name of the ETF, the top 10 holdings, what that percentage is, how they break down into the various 11 sectors. And then the beauty is you can go in and decide after researching, you might say, you know what, I don't want that one. I want 10% of this one. I want 20% of this one. I want 15% of this one. So that's at 45%. I want 10% of this one. I want, I don't know, 12% of this one. And then we'll do 10% of this one and 15% of this one. You might think to yourself, okay, I'm done. And you go up and this tells you it's an error. All of these allocations you did only totaled 92%. So it's got to equal 100%. So it even has a built-in function to make sure that you're totaling 20%. So you might want to say, well, that 12, I meant 20. You know, maybe you typed it in wrong. Now you're at 100%. And now you can see your results and what you've got. 23% in industrials. So now you've more than tripled the S&P on industrials. Well, guess what? If industrials don't have a good quarter, you're probably going to underperform. And you know what else? You're going to know why, because you know what you own. If you just get 10 ETFs and you haven't gone through this, how do you even know what you own? You might have 45% in technology, or you might have 30% energy, and maybe that's what you want, which is fine. But do you know what you own? That's where all of this comes in. So the last draft, what we did, here was the actual allocations. We had 10% in the ACWV. We had 20% in this high probability or profitability ETF. We had 20% in the QQQ. We had 15% in this minimum volatility. That's going to be a more defensive type of a ETF. 5% in communication services, the XLC. 5% in financials. 15% in technology. We wanted a pump up technology a little bit, because remember, back in July, I'm thinking more aggressively because I'm thinking the bottom's in. So we put another 10% directly into the XLY. Now, if you know these, you know that they're heavily concentrated technology, heavily concentrated in Apple and Microsoft. Consumer discretionary, heavily concentrated in Amazon and Tesla. I know what I own by putting this together. I deliberately wanted some of these names in there. So anyway, last quarter, what we had was 36% technology in our model ETF portfolio. The S&P 500 was only 27%. Consumer discretionary was 17 versus 10. Communication services, I was 11 versus 8. Industrials, I was 6 versus 8. Financials, 8 versus almost 11. What I really cut back on was healthcare, real estate, utilities, the defensive groups, energy and materials, not much. And in this last quarter, I underperformed a little bit, and I know why. That right there, technology did not have a good quarter. That 36% didn't help me. I know industrials had a really good quarter. Industrials, I had underweighted a little bit. Healthcare just broke out to an all-time relative high. I think that was today or yesterday. I think it was today. And only had about 60% of what the S&P. So I know why I made some good calls. I mean, real estate's been awful. I hardly had any real estate in there. That was good. Consumer discretionary for periods of the quarter did extremely well, had a really nice bounce back, and I was out, I had overweighted that group. My point is, if you know what you own, you can look back after a period, whether it's 3 months, 6 months, a year, or whatever, and you can look at yourself in the mirror and you know exactly why you underperformed or outperformed. And that's the whole idea behind putting this portfolio together, the model ETF portfolio. And next week, when we actually do this portfolio and we announce it, I will go through and I'm going to walk through why I picked the ETFs that we picked. I'm going to walk through the percentages that we're putting in, and I'm going to talk about the results and why I have the weighting that I have versus the S&P 500. Because if I want to beat the S&P 500, I need to be thinking about areas that I believe are going to beat the S&P 500. Those are the areas I want to overweight. Now, I could get crazy and I could just put 100% of my portfolio in the XLK and just hope and pray that technology has a great quarter. Probably not the smartest move for most people. I mean, it'd be great if we jump back into that secular bull market, because the XLK tends to be the best performing sector ETF in secular bull market advances. So that could turn out to be a great decision. But what if this is a secular bear market? What if stocks like AMD, we think 58 is a good price? What if they're 38 3 months, 6 months from now? What do you think is going to happen to this XLK? And what's going to happen to your portfolio if that's the only thing you have in it? So everybody could use this to help diversify. You can see exactly what you're putting in to your portfolio. I think this is the greatest thing I've ever seen with ETFs. And this is the type of research and education that we like to provide at Earnings Beats. So that is essentially what I wanted to go over tonight. I'll be developing the themes. I'm going to look again next week. We're going to get another big inflation report tomorrow and get a sense, of how the market's reacting to it. The rotation, I'll be watching that next week. I mean, if all of those relative ratios that I was showing you all roll back over and go down and set new lows, we have a different ball game. So for those of you saying, okay, well, what would it take for you to believe that this is secular versus cyclical? That's one thing. Because if we're going to go down for another year or two, we ain't going to be led to the downside by defensive groups. We're going to be led by the aggressive groups. So they're going to have to roll over. As long as they continue to hold on to that June or May low on a relative basis, I'm going to believe that we are being manipulated by Wall Street, by market makers. And while some folks are panicking because we're setting new lows on the S&P 500, I'm looking under the surface of the market and I'm seeing a completely different picture. And that's why I am in the QQQ. That way I don't have to try to pick my individual stocks, because, you get in, I definitely would not be picking AMD. But if you pick a stock and you're in the wrong stock, you might have a great call and just be in the wrong stocks. And so when the market's volatile, I tend to trade more ETFs and fewer individual stocks until we get into a defined uptrend. And once we see that, and I see the leadership, different ball game. I will be into individual stocks and I'll be in the leaders. But we still got some work to do before we get there. Anyhow, that's it. I don't know, John, if you have anything to add or if there are any questions, I'll be happy to answer them.
Yeah, I know you're gonna know the answer. I know you're gonna know the answer to this one. Hold on a second.
Yeah, it sounds
There's a
like
dog in the background.
we got a dog of a market.
Yeah, what do you think the CPI might come out tomorrow?
What do I think?
Yeah,
I mean, I have no idea. PPI, I thought the headline number on PPI was going to be down below expectations just because the price of crude oil from the different measurement dates was down. But I know some of the food prices were up. But I thought we would probably have seen a little bit lower PPI than we did. We saw some selling going into the close. I don't know whether that means anything or not, but for me, it's more about how the market's reaction, throughout the trading day tomorrow and the next few days, the next week or two, than it is about whether PPI is higher or lower. Because again, is the market or is Wall Street looking at this as an opportunity to get into some of these growth stocks versus value, aggressive versus defensive? If that's what's happening on the charts, I don't care what's happening on the news. That's just the way I approach the market. So I think the reaction is going to be much, much more important. If the number's higher than expected, I would expect to see a gap down. I would expect to see the VIX, 35 or whatever. And then what happens from there? Do we get that big reversal? That's one thing that's missing right now. Many of the other bottoms that we saw earlier this year, we've seen big reversals, big intraday move lower. I mean, today was kind of boring, even though we were setting another low. Yesterday I didn't think was all that exciting, although I really didn't watch it that closely because I was traveling in travel mode. But it just seems like maybe, some have said, well, don't we need capitulation? I think to some extent we had it back in June. I mean, went down 10% in 5 trading days. I'm not quite sure what we need. That needs to be a whole lot more than that. But anyway, yeah, I mean, if we saw an intraday move and all of a sudden from 11 to 4 o'clock, things reversed and we went straight up, I would love to see a day like that. That would probably get me a little bit more aggressive in terms of QLD versus QQQ. But I don't know. We just have to kind of watch it and see, John. I'm not sure.
okay. The other funny thing I find is that, the VIX is trading 33, 34, 35. And, the media is, treating it like it's just sort of normal. It's not exact, maybe not huge capitulation, but those are pretty lofty fear readings.
Yeah, anytime you get up into the 30s, you can have a bottom at any time. And, we talk about the 5-day moving average of the put call ratio. That has hit levels that, 0.80, 5-day moving average of the equity only put call ratio, 0.80. If every time that we've had a significant market bottom this century, every time the 5-day moving average of the put call ratio has been at least 0.75. That's why back earlier this year, when we were hitting bottoms, we were seeing the 5-day moving average of the put call ratio moving up, but we were only seeing it get up to like 0.60, 0.62. That was not resetting the sentiment. We've now gotten to levels where I believe the sentiment has been reset. Maybe we go a little bit higher, but we could launch from here. We could launch at any time back to the upside and go to all-time highs. So you can keep, stay on the bearish side. If that's what you're most comfortable with, stick with it, but maybe just keep this conversation in mind, in the back of your head, because when we ultimately do bottom, the average return over the next year is about 45%. Anytime we bottom, that's going back to all bear markets since 1950. The average 1-year return from the bottom is 45%. Keep that in mind. And again, that's the average. We've seen as much as 80, and I think the lowest was 29%. So we could be, if I'm right about the bottom, we could be looking at a massive reversal back to the upside. So anyway, I'll just leave it at that.
Yeah, well, I mean, and you think about it too, when these readings come out, CPI, PPI, Fed minutes, et cetera, honestly, you're not paying attention if you don't think that the market's priced an awful lot of that in. Who's not thinking, the Fed's going to raise another 75, maybe at the next meeting? It's not like this would be a big surprise, but I think it's the negativity in the air, and all you're hearing about is a bear, 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 that people don't want to pull the trigger. And before you know it, the market's up 10, 15, 20%, and then they start getting interested in getting involved. So I don't know. We've been doing this quite a long time. I think the sentiment's so bearish here that the reward to risk is, to the upside, especially if you can, keep some kind of a stop in place in case things start, falling more. But it just seems to me like and going into the fourth quarter, even looking at the AMAT down a little bit after hours, there would be times when that thing could be down to 10 or 15%. And maybe ultimately that's what happens. But
Yeah.
I think so much negativity has been already put into the market that any positive surprise has got to really could potentially turn things around.
Yeah, I wanted to talk about one other thing before we go here, and that's just this is since November of 2021 all the way through to like a week ago, maybe a little over a week ago, the green shaded area. Anyhow, I believe the market is in the third phase, which I'm calling this bullish manipulation phase over here. But we start off with a bearish manipulation phase. Remember, the S&P went up to a new high at the end of 2021 and the beginning of 2022. But on that last move right here, we went up $10 on the spider. And that $10, we went up $10 in net gaps. If you take the net gap of all these gaps in here and you add them together, we actually went up $10 in gaps here. And the rest of the trading day was just a wash. It was just a net zero. So this was not a lot of buying that was going into this. This was simply the last gasp where money was being rotated, where Wall Street was using a lot of strength to get out of positions, move out of discretionary, move into staples. It was all just a big wash and rotation. Then we went through what I call the period of distribution from January to May, where the opening gaps, we went down $85 on the spider. 25 of it was at the open, but 60 of it was during the day. We actually were selling off in the spider throughout the day to the tune of 60 of the $85. That's distribution. I want you to take a look at, excuse me, where we were on May 20th and where we were at the beginning of October. I think this may have been October 3rd. The spider went down $20. The opening gaps were $47 lower. After the opening gap, if you net all of this out right here, $28 or $27, $28 of buying during the day while it's dropping overall. This to me is the opposite of what we saw back here. I believe that we are seeing the news drive a lot of retail traders into selling at the open. And we're seeing really bad news. And then we've got buyers coming in during the day. Who are these buyers? I don't know, but we've gone up $27, $28 on the spider since May 20th during the day. In other words, you would have made money if you had just waited for the opening bell and bought the spider sold it at the closing bell, and then did it again the next day and the next day, you would have made a bunch of money since May 20th. We're not seeing the selling during the day on a net basis. It's all at the open. $47 down at the open, and we've only lost $20 during the entire period. I think we are being manipulated like nobody's business. And this plays into the rotation that I'm seeing. We'll find out. Maybe it doesn't matter. Maybe we keep going lower. I think this is a really big deal. So anyway, figured I'd close on that.
Okay, let's wrap her up.
All right. Appreciate everybody tuning in. I'll be back tomorrow. I am going to do a Trading Places live. It'll be the recording, but I think I'm going to do that for stock charts tomorrow. I apologize to any members who came in this morning. I was just beat. I was planning on trying to do the Trading Places live this morning, and the jet lag and everything else, I'm like, we'll just wait a little bit. And so I ended up just taking this morning off with that. And I had to prepare for this today, as well as write the daily market report and get kind of back into something. I'm updating chart lists, which I'm hoping to have those available for a lot of folks tomorrow as well. Try and get through some of those. So anyway, but that's it for me. We will be back tomorrow. You can go over to Stock Charts TV at 9 a.m., click on that, and you'll be able to check in to the next Trading Places live episode. Hopefully everybody be back next Wednesday when we do this model ETF portfolio draft. I think it's really educational. I think you'll learn a lot. So hopefully see you next week. For those of you who are new to Earnings Beats, you can come on as a member, as a 30-day free trial member, and be eligible for all of these sessions. So make sure you take advantage of that. Have a great night, everybody. Happy trading.